top 3 things you should know during a recession. The first one is don't just buy the dip, focus on the quality of the stock you want to buy. During a recession, a lot of stocks and a lot of funds tend to be way below their all-time highs. I mean, look at Cathie Wood's ARK fund, more or less 300% down and way below its all-time highs in 2020. But we hear this a lot in the news, in our lectures, from our friends, just buy the dip. It's like, no, this is one of the worst investment advices literally out there. Just because a stock is 50% down from its all-time high doesn't mean it's at a discount, and also doesn't mean it's a stock to buy. Just because a stock is down doesn't mean you should just buy it automatically. If the business rationale is not good enough, then it doesn't make sense to buy it just because you believe there's some upside. During a recession, your focus should be to find quality businesses that are at a discount, and this is a time where you actually want to act like a value investor, and this is a term coined by Warren Buffett. If you think the market isn't pricing a company appropriately, by all means please buy the dip, but to know that you need to have some alpha, you need to have done your proper due diligence and know for sure that there's 20% upside in this stock. And also during a recession, a focus on quality could help investors like you and me mitigate their exposure to companies that are more at risk from higher interest rates and further tightening of bank lending standards. If you actually look at it, notably the S&P 500 quality index has a net debt to EBITDA ratio of just 0.87. We actually contrast that with the market average of 1.45. This disparity is actually more pronounced among small caps and value factors. The next important thing you should know during a recession is the negative correlation between stocks and bonds. Negative correlation means the two securities move the opposite way. So for example, if Tesla and Goldman Sachs are negatively correlated, if Tesla is up, for example, 10%, then Goldman Sachs will be down 10%. Or if they're positively correlated, if Tesla is up 10%, then Goldman Sachs will be up 10% as well. In the first 2 decades of the 21st century, the stock and bond correlation was consistently negative, meaning investors were able to rely on their bond investments for protection when equity sold off. But this is almost no longer the case, and this is due to macroeconomic changes such as high inflation uncertainty, and this is something investors need to be well aware of. If you watched my last video about how to invest, depending on what age you are, you'll have seen I said when you're young, I mean 18 to like 30, you want to double down on risky investment. So technically, this should not concern you during a recession. The negative correlation between stocks and bonds are more for people that are trying to hedge the risk in the portfolio. Typically people that are almost 40, 50 and 60. They don't want to be exposed to long beta. They don't want to be exposed to risky assets, and as such, with this correlation breaking down, this affects them more. And the last thing you should know about during a recession is lump sum versus dollar cost averaging. What is lump sum? Lump sum is the act of investing all your available money at once. The amount of money being invested is actually not important, only that the entire amount is invested. Whereas dollar cost averaging is the act of investing all your available money over a period of time. How you actually decide to invest these funds over the time is up to you. You can make it £50 every day, you can make it £2 every day. The whole point is this is invested over a period of time. During a recession, there's a tendency for people to actually hold on to cash and start to practice dollar cost averaging because they're scared of putting their money or all their money straight into a stock and losing all of it, since a lot of stock prices actually tank. But the research is clear. Lump sum investing outperforms dollar cost averaging if you look at the stock market returns from 1994 all the way to 2022. Therefore, if lump sum investing outperforms dollar cost averaging, your main takeaway should be gather conviction in your investments and prepare to go all in at once. Rather than trying to allocate that money over a long period of time, it's best to utilize a lump sum strategy. If you put the 3 things I talked about, what's an actionable investment strategy? The first thing you should do is don't just buy the dip. Find quality businesses at a discount. Gather conviction in that. Do not worry about the breakdown between the stock and bond correlation, and prepare to invest in a lump sum way rather than dollar cost averaging. So for example, if ABC stock is 100% down and you believe that ABC is a very good business, what you should do is research that business, gather extreme conviction, and if you have £1,000 to invest in that, invest your whole £1,000 in the ABC business. Do not try and invest £100 for the next 10 months, for example. That always underperforms a lump sum investment strategy. Hope you enjoyed the video, guys. Like, comment, subscribe, and let me know what you think in the comments. What else do you think we should know during a recession? I'll actually reply to every comment that brings up an idea, and I'll actually be prepared to talk about that in the next video. So see you in the next video, and thanks for watching.